Right now, as you're watching this, there's a building in your city holding roughly 9% of the money people think is in there. The rest doesn't exist. Not in a vault, not in a safe, not anywhere you could touch it. And yet every single day, millions of people walk into banks, swipe cards, and move money that isn't there. The system works perfectly, until the moment everyone realizes the same thing at once. That moment has a name, and it's happened before. But let's start simpler. Let's start with what a bank actually is, because the answer is weirder than you think. Imagine you're 5 years old. You have $10. Your mom says you can keep it under your pillow, or you can give it to her, and she'll keep it safe. You pick Mom. Now, here's the thing. Your mom doesn't just put your $10 in a drawer. She looks at it and thinks, my kid isn't asking for this money back today. Probably not tomorrow either. So she takes 7 of your dollars and lends them to your neighbor to fix his car. Your neighbor pays her back later with a little extra, let's say $7.50. You still have $10. You can ask for it anytime. But your mom now has $10.50 in total floating around. She created money out of thin air using yours. That's a bank. That's the entire concept. The sophistication comes later, the regulations, the insurance, the federal oversight. But the core trick, it's the same. You deposit money, the bank lends most of it out, you still think it's yours, and technically it is, because the bank promises you can withdraw it whenever you want. They're just betting you won't. Not all at once, anyway. Here's the part people forget. Banks didn't invent this system to scam anyone. They invented it because it's useful. Think about it. If every dollar you ever earned just sat in a box forever, the economy would freeze. No one could borrow money to start a business. No one could get a mortgage. No one could buy a car unless they'd saved up the full amount in cash. Banks are middlemen. They take money from people who have extra right now and give it to people who need it right now. The person saving gets a tiny bit of interest. The person borrowing pays a lot more interest. The bank keeps the difference. In 2024, the average savings account in the U.S. paid about 0.4% interest. The average mortgage rate was around 7%. That gap, that's the profit engine. And it works because of trust. You trust the bank has your money. The borrower trusts the bank will actually lend it. The whole system hums along as long as no one asks too many questions at the same time. But here's the thing about trust. It's not a fact, it's a feeling. And feelings can change fast. Let's say you deposit $100 at a bank. The bank is required by law to keep some of that in reserve. In the US, that number has changed over time. For a while, it was 10%. During COVID, the Federal Reserve actually dropped it to 0. As of now, it's back to around 10% for most banks. So they keep $10, they lend out $90. That $90 gets deposited into someone else's account, maybe a contractor's. That contractor's bank now has 90 new dollars. They keep 9, they lend out 81. That 81 gets deposited somewhere else. Keep 8.1, lend out 72.9. You see where this is going. Your original $100 just became $271 in the economy, not because anyone printed new money, because the same money got reused over and over through lending. Economists call this the money multiplier. It's not a trick, it's fundamental to how modern economies grow. But here's the uncomfortable truth. That system only works if people don't all want their money back at the same time, because the money isn't there. December 1930, New York City, the Bank of United States. Not the United States Bank, just an unfortunately named private bank in the Bronx. Rumors started going around that the bank was in trouble. People got nervous, a few people showed up to withdraw their money, then a few more, then hundreds. The bank had loans out, it had investments, it had plenty of assets on paper, but it didn't have cash, not enough to give everyone their deposits back on the same day. Within 48 hours, the bank collapsed. 400,000 depositors lost everything. That's called a bank run, and once it starts, it's almost impossible to stop because the fear becomes the problem. Even if the bank was fine yesterday, it's not fine anymore once everyone's trying to pull their money out. The Great Depression saw more than 9,000 banks fail in the US alone. 9,000. People learned a lesson. Money in a bank isn't actually safe unless someone bigger promises it is. That's why in 1933, the government created the FDIC, Federal Deposit Insurance Corporation. They insure your deposits up to $250,000. If your bank fails, you still get your money. The government backs it. Problem solved, right? Not exactly. March 2023, Silicon Valley Bank, one of the 20 largest banks in America, failed in under 48 hours. Why? Because it did what banks do. It took deposits and invested them, mostly in government bonds, which are supposed to be safe, but when interest rates went up fast, the value of those bonds dropped. The bank had assets, just not liquid ones. A few big venture capital firms started quietly telling their startups to pull their money out. Word spread. Social media amplified it. Within 2 days, people tried to withdraw $42 billion. The bank didn't have $42 billion in cash. No bank does. Silicon Valley Bank collapsed, the 16th largest bank failure in U.S. history. 2 days later, Signature Bank failed. A week after that, First Republic was teetering. The FDIC stepped in. The government backstopped uninsured deposits. The panic stopped. But here's the thing. The mechanics that caused the panic haven't changed. Banks still hold a fraction of deposits in cash. The money multiplier still exists. The system still runs on trust. And trust in the age of Twitter and instant transfers evaporates faster than it ever has before. Let's get specific. You put $1,000 in a checking account. The bank doesn't just sit on it. They can't afford to. They have employees, buildings, technology, regulators breathing down their neck. So they lend it. Mortgages, car loans, credit cards, business lines of credit. But they also invest it. Government bonds, corporate debt, mortgage-backed securities, sometimes riskier stuff. In theory, they're being careful. There are rules, capital requirements, stress tests, regulators who check the math. In practice, banks are profit-driven companies, and profit comes from risk. The safest investment pays almost nothing. The riskier the investment, the higher the return. So every bank is constantly making a bet. How much risk can we take before it becomes a problem? Most of the time, they get it right. Sometimes they don't. 2008 wasn't a fluke. It was the inevitable result of banks making increasingly risky bets with money that wasn't theirs, packaged in ways that hid the risk, backed by models that assumed housing prices would never drop nationwide. They dropped. The bets failed. The banks needed a bailout. Taxpayers covered it. $700 billion. The banks survived. The system survived. But nothing fundamental changed because the system isn't broken. It's working exactly as designed. The risk is a feature, not a bug. So let's zoom out. Banking isn't some neutral utility like water or electricity. It's a machine designed to create growth, to turn present money into future money, to make the economy bigger year after year. And for the most part, it works. Countries with stable banking systems grow faster. People can buy homes, businesses can expand, innovation gets funded. But there's a cost. The cost is fragility. Every time a bank lends money, it's making a prediction about the future, that the borrower will pay it back, that the economy won't collapse, that interest rates won't spike, that there won't be a pandemic or a war or a sudden wave of panic. Most of those predictions are right, but not all of them. And when enough predictions are wrong at the same time, the whole thing wobbles. The solution so far has been the same every time. The government steps in. Central banks lower interest rates. Regulators offer emergency loans. Deposit insurance kicks in. Taxpayers backstop the system. It works until people start wondering whether it always will. Because here's the uncomfortable question no one really wants to answer. If banks are too big to fail and the government will always save them, what's stopping them from taking bigger and bigger risks? The technical term is moral hazard. The simple version is, if you know someone will catch you when you fall, you start walking closer to the edge. So let's come back to where we started. There's a building in your city. It has a vault, cameras, people in suits. It holds about 9% of the money people think is in there. The rest is a promise, a legal obligation, a line of code in a database. It's not a scam, it's not fraud, it's fractional reserve banking, the engine of modern capitalism, the reason economies grow, the reason you can get a mortgage without waiting 30 years to save up. But it's also a system held together by collective belief, by the assumption that tomorrow will look like today, that the math will keep working, that everyone won't ask for their money at the same time. And maybe that's fine. Maybe that's just how complex systems work. A little bit of risk, a little bit of faith, a lot of regulation, and a government willing to step in when things go sideways. Or maybe we're all just walking around with receipts for money that doesn't exist, hoping the music doesn't stop. Your call.